Welcome to the deep dive. Trying to figure out today's markets can feel, well, a bit crazy sometimes. Like you're getting signals telling you completely opposite things. One minute it's all systems go, the next it's maybe you hit the brakes. So how do you actually make sense of it all, especially when the information itself seems to be fighting? That's exactly what we're tackling today. We're going to dive into the latest market intel, unpack some of these opposing forces we're seeing, and hopefully give you a clearer picture. Really, our mission is to give you a framework to understand what's actually driving certain stocks and how you might approach them. Cut through some of that noise.
Exactly. And it's not just about knowing what happened in the last, say, 24 hours. It's about digging into the why. Why does this matter for your understanding, for your view
Sure.
of the market? We'll use a few analytical tools, think concepts like Bayesian inference, basically, how we update our views with new facts and first principles thinking, really just trying to get to the core signals.
Okay, let's do it. To get a handle on things, we really have to start with the big picture, the macro stuff, and specifically this idea of a dovish pivot from the Fed. So for quite a while, the market was thinking, okay, the Fed's going to be cautious, probably no rate cuts until maybe Q4, right? Because inflation was still kind of sticky. That was the story.
Right, that was the baseline assumption. But then, bam, we got some really potent new evidence. The May CPI report, the inflation numbers that came out back on June 11th, and they were surprisingly soft. Headline CPI, just 0.1% month over month. That brought the yearly rate down to 2.4%. And maybe more importantly, core CPI, taking out food and energy, also just 0.1% month on month. The annual rate dropped to 2.8%.
And that was lower than expected.
Yeah, lower than consensus across the board. And that signal, honestly, was probably the most powerful market-moving piece of information we've had in the last day or so. It just instantly flipped the script.
Okay, so soft inflation, market gets excited about rate cuts. But then there's a twist, right? Because yesterday, July 9th, the minutes from the Fed's June meeting, the FOMC minutes, they came out. And they showed, well, quite a bit of disagreement inside the Fed.
Significant internal division, yeah. You had a couple of members saying, hey, maybe we could cut rates as early as July, but then you had some members arguing they should hold rates steady for the whole of 2025.
Wow. Okay, so that definitely throws some cold water on the idea of a quick, easy path to rate cuts. Creates uncertainty.
Exactly. It introduces this layer of policy uncertainty. So thinking about that Bayesian idea, our belief about the Fed's path, it's updated. The probability of a rate cut definitely shifted forward. September is now looking like the base case, and July odds went up too.
Right.
The market basically went from, let's say, cautiously optimistic to pretty aggressively bullish, especially for those rate-sensitive tech stocks. But those FOMC minutes, they act as a dampener. They moderate that enthusiasm a bit. Still, the CPI data, that hard number, that's the stronger immediate driver right now. Any analysis you are doing based on the older, higher inflation numbers, it's kind of obsolete.
So putting it all together, what does this mean for the next 24 hours? We've sketched out a few scenarios. The most likely, we think, about a 65% chance is what we're calling dovish continuation. Basically, the market keeps riding that positive wave from the soft CPI, believing the Fed has the green light to cut sooner. This probably pushes tech higher, maybe takes the S&P and NASDAQ to new records. The VIX, the fear gauge, likely stays low.
Makes sense. Then scenario 2, maybe a 25% probability is an overbought reversion. Here, the market says, okay, the good CPI news, it's kind of priced in already after that first jump. Attention then shifts to, well, how stretched the market looks technically. The S&P 500's RSI, that momentum indicator, is up around 75. Historically, that often means a pullback isn't far off, and those divided FOMC minutes, they could be the excuse, the catalyst for people to take some profits.
Gotcha. And the third one? Less likely.
Yeah, the lower probability one, maybe 10%, is a tariff shock. This is where those background worries about trade tensions suddenly flare up. Maybe some unexpected tough tariff news hits. That could totally override the dovish Fed story and trigger a classic risk-off move. Stocks sell off, especially multinationals. People run to safety like treasuries.
Okay, so that's the potential landscape. Looking at how things actually played out yesterday, what do we see in the market and sectors?
Well, their reaction was definitely positive, leaning into that dovish story, but the leadership was still pretty narrow. The S&P 500 closed up 0.61%, right near its all-time high, at 6,263.26. That push really came from the big tech names, the Magnificent Seven, especially NVIDIA, and the NASDAQ, being so tech-heavy, naturally led the way, up 0.94%. New record close at 20,611.34. Its fate is really tied to those giants.
And the Dow, it lagged a bit.
It did lag tech, but still a solid gain, up about 0.5% to 458.30, still just below its own record high. What's interesting in the Dow is the strength came from sectors like industrials, think Caterpillar, Boeing, and energy. That suggests maybe the rally is broadening out a little beyond just tech. That sometimes happens in what looks like an early phase of a business cycle, when growth hopes pick up.
Okay, and sector-wise, who were the winners and losers yesterday?
Yeah, looking at the rotation, information technology and industrials were clearly the outperformers, tech riding that AI and rate cut momentum. On the other side, defensive sectors lagged. Healthcare was down almost 1%, partly hit by those renewed tariff worries affecting big pharma companies. Consumer staples like P&G, Coca-Cola, also weak as money moved out of safety and into growth.
Okay, so tech leads, some cyclicals joining in, defensives lagging. But you mentioned something earlier about the narrowness, a deeper issue, a vulnerability.
Right, the systemic vulnerability. While the rally feels strong, it's standing on a pretty narrow base. The S&P 500's gains are super concentrated. Get this. NVIDIA alone is now 7.3% of the entire S&P 500 index weight. That's more than Apple and Microsoft.
Wow, 7.3%. Just one stock.
Yeah. And this creates this powerful feedback loop. Passive index funds like SPY or QQQ, they get money in. They have to buy these top-weighted stocks like NVIDIA. That pushes the price higher, which increases its weight even more.
So the buying almost forces itself.
Exactly. And the risk, if something negative hits just NVIDIA, maybe company-specific news, it could trigger a huge sell-off across the whole market because all those index funds would be forced sellers at the same time. The market's overall health is just really, really tied to a handful of these mega caps right now. It's like an AI gravity well, sucking capital in, making the broader market kind of fragile underneath.
Okay, that's a really important context. So with that macro picture and that vulnerability in mind, let's zoom in. How do we apply this to specific stocks, especially when signals conflict? You mentioned a first principles approach.
Yeah, the core question for any stock we look at for a short-term trade is, why this stock right now? Why is it relevant in the next 24 hours? It needs to be driven by something fresh, something impactful that creates a clear, ideally conflicting signal we need to resolve.
Makes sense. So let's look at some tickers where these conflicts are really playing out.
Perfect. First one, got to be NVIDIA, NVDA, the market engine, but also flashing that overbought signal.
And the big news trigger, obviously, hitting that $4 trillion market cap yesterday, July 9th. Even if it was brief, that's a huge psychological number. Just cements its leadership in AI
Right.
and its role driving the whole market.
Absolutely. Technically, things look strong. Momentum indicators like MACD, on balance volume, or OBV, they're showing strong buying pressure, clear uptrend, holding above key averages. But, and here's the conflict, the RSI, the relative strength index, is up at 68, almost 70. That's traditionally considered overbought territory.
Yeah.
Signals maybe things have gone too far, too fast, risk of a pullback.
Okay, so momentum strong, but maybe stretched. What about other factors? Shorts, options.
Quantitatively, short interest is tiny, less than 1%. So this isn't a short squeeze rally, it's real buying. Options market, very bullish. Put-call ratio is low at 0.58, meaning lots more call buying than put buying. And institutional ownership is massive, around 74%.
And sentiment.
Mostly euphoria. FOMO, fear of missing out. You see bullish all over stock tweets. But there's also this kind of contrarian bearishness starting to whisper, which you often see near peaks. So how do we resolve this? Our take is that in a powerful news-driven trend like NVIDIA's, momentum usually wins in the short term. That $4 trillion story is probably stronger right now than a standard RSI reading. The stock keeps making new highs, confirming the trend.
So lean bullish.
Lean bullish, yes, but that overbought signal isn't meaningless. It tells you to be careful with risk management. Maybe use a tighter stop loss than usual just in case it does snap back.
Okay, next up, Apple, AAPL. You called it the geopolitical barometer.
And mentioned divergent sentiment. Yeah, the news trigger here was that comment from a White House trade advisor suggesting Apple thinks it's too big to tariff. That kind of stirred up those geopolitical risk fears again. There was also a routine COO transition, but the tariff talk was the main thing.
And technically, how's it looking?
Technically, it's pretty neutral, actually. Our weighted score suggests consolidation. MACD is positive, but barely not accelerating. RSI is neutral around 57. Price is just sort of bouncing around its short-term VWAP, the volume-weighted average price. It's in balance. The conflict comes from the on-balance volume. Short-term OBV looks okay, suggesting some recent buying, but longer-term OBV is negative, which hints at some selling happening underneath that accumulation. Kind of mixed signals there.
And quantitatively, Shorts, options again.
Short interest is super low, 0.67%, but the options market is leaning bullish. Volume put-call ratio 0.58, open interest PC 0.75. So more calls being traded and held than puts suggests people are betting on upside or maybe hedging. Institutions own a huge chunk, about 70%.
Okay, so technicals are meh. Volume is mixed, but options look bullish. What about sentiment? You mentioned divergence.
Right. Those tariff comments, they spooked retail traders. Sentiment on stock twits flipped to bearish. That's the kind of first-level emotional reaction. But that bullish options data suggests the smart money, maybe institutions, they might see the tariff talk as just noise, unlikely to hurt Apple much. Or they're using options to play against that fear.
So how do you weigh those? The scared retail versus the potentially bullish institutions.
In this case, we'd probably give more weight to the quantitative signal from the options market. It often reflects where bigger players are positioning their capital, and it tends to be less reactive than headline-driven retail sentiment.
Interesting. Okay, let's move to plug power, PLUG. You flagged this as a fundamental inflection point battling against historical skepticism.
Yes, exactly. The big news here is PLU announced a new multi-year supply deal with a major U.S. industrial gas company. And crucially, they explicitly said this deal will immediately lower their costs and improve margins. That hits right at the heart of the main arguments against PLU, that they just burn cash and don't make money.
So potentially game-changing news for their fundamentals. How did the stock react?
Like a rocket. Technically, it's a strong bullish reversal. MACD turned positive and is rising. RSI surged over 70, confirming the strength. It blew through all its key moving averages and VWAPs. Classic reversal signal. And the OBV shows huge buying volume came in.
And the quantitative side. This sounds like it could trigger something given its history.
Oh yeah, this is where it gets explosive. Short interest is extremely high, almost 24% of the float. That means a massive number of people were betting against the stock.
24%. Wow.
Yeah, and the options market? Insanely bullish. Volume put-call ratio is down at 0.11. Just tons of speculative call buying.
So the news hits, shorts are underwater, call buyers are making bank.
Exactly. It caused relief for longs, panic for shorts. The stock surged 25% yesterday on absolutely massive volume, over 228 million shares traded.
So the resolution here seems pretty clear.
Very clear. That supply agreement news is potentially transformative. It could invalidate the old bearish reasons for shorting the stock. The market's reaction, that huge price jump on massive volume, is the confirmation. You prioritize the new signal, the news, the volume over the old history. This trade is now about the potentially improving fundamentals and the mechanics of that massive short squeeze.
Okay, fascinating. One more. GameStop, GME, the coiled spring. Always interesting. What's the latest conflict there?
Well, no single big news catalyst in the last 24 hours for GME, but it's always in the spotlight, right? Meme stock status, talk about share dilution, leadership moves. It's constantly simmering.
And the technical picture, still messy.
Yeah, technically it's kind of bearish to neutral, but the main feature is this coiling action. The price range is getting really tight. MACD is technically bearish, but maybe trying to cross over. RSI is recovering from being oversold, but still weak, below 50. It's below key moving averages, but finding some support around $23 near its intraday VWAP. OBV is negative.
So weak technicals overall, but you say coiling. Like building energy.
Exactly. That's the conflict. The standard indicators look poor, but the price action itself, that tight compression, suggests energy is building up for a potentially explosive move, either up or down.
Right. And quantitatively, still a lot of shorts. Options still crazy.
You bet. Short interest is still very high, nearly 19.5% of the float, so highly prone to a squeeze. And the options market is extremely speculative and bullish. Put-call ratios are super low, like 0.24, with tons of interest in those way out of the money calls.
And sentiment. Still a battleground.
Absolutely. A coiled spring describes it perfectly. It feels like a stalemate. Shorts are holding their ground. Dedicated longs aren't selling. The low volume we sometimes see isn't lack of interest. It's more like a tense standoff before something breaks.
So how do you even analyze a stock like this? Traditional rules seem out the window?
They mostly are. GME doesn't trade on normal fundamentals or technicals. It's driven by sentiment, retail flows, and market structure specifically, options, gamma hedging, and that huge short interest. So for GME, the quantitative data, the short float, the options skew, that's way more important than looking at a MACD line. The technical compression matters only because it shows you where the launch pad is for all that stored energy driven by the quants to potentially release. It's its own little ecosystem.
Wow. Okay, so we've looked at the big picture, the conflicting signals, and dived into these specific stock battles. Now, the crucial part, what does this mean for you, the listener? How do we make this actionable? You mentioned scenarios and action plans.
That's the goal, to move from analysis to a concrete plan. You need a framework so you're not paralyzed when things start moving. For the key stocks, we lay out clear bullish and bearish scenarios. Each scenario has specific triggers like a price level break, confirmation signals, maybe volume surge, price targets, and critically, a stop-loss zone to manage your risk. Plus, we assess the risk-reward and assign a probability.
Can you give an example, like for NVIDIA?
Sure. For an NVDA bullish scenario, the trigger might be a clean break and hold above, say, $164.50. Confirmation could be an hourly close above $165. Target 1 might be $167.50. Target 2, $170. And your stop loss is set below, maybe at $162. Having that plan for both up and down moves is key.
Oh, for something wilder like GME.
Right. For a GME bullish scenario, trigger could be a break and hold above $24. Confirmation might need to see a huge volume spike, like over 20 million shares in the first hour. Target 1, maybe $28. Target 2, $32. Stop loss, perhaps $22.50. Clear rules of engagement.
Okay, that makes sense. Beyond those individual stock plans, are there broader strategies or ripple effects we should be thinking about? You mentioned second-order thinking.
Yeah, looking beyond the immediate stock, for instance, that big move in plug power, that could ignite a hydrogen sympathy play. Traders who missed Plebin might start looking for the next one. So money could flow into other clean energy or hydrogen names like Bloom Energy, BE, Fuel Cell Energy, FCEL, or even ETFs in that space like PBW or ICLN. That's a potential second-order effect.
Okay, what else?
Then there's the WK Kellogg acquisition news we touched on briefly. That could trigger an M&A contagion effect in consumer staples. It makes people look again at other struggling food companies, wondering if they might be takeover targets too. Could spark some short-term buying in names like Conagra, for example.
And the most obvious one, probably with NVIDIA.
The AI index effect. Definitely. NVIDIA's strength isn't just about NVIDIA. It lifts the whole semiconductor and tech world. When money flows into ETFs like QQQ or the semi-ETF SOXX, partly because of NVIDIA, it reinforces the rally in the whole group. It's that feedback loop again.
Got it. So tying this all together, you mentioned ranking these trade ideas based on conviction.
Yes, based on everything we discussed, the catalyst clarity, the risk reward, the probability we've ranked, the setups we focused on for the next 24 hours or so. Rank 1, highest conviction, is actually WK Kellogg, KLG. That bullish M&A catalyst is very clear. There's high short interest and a defined price from the deal. Rank 2 is Plug Power, PLU, also a bullish squeeze play. Strong new, fundamental reason, massive volume confirmation, very high short interest. Rank 3 is NVIDIA, NVDA. Bullish trend continuation, powerful narrative, strong institutional backing, but maybe a bit extended short-term.
Okay, and the last two.
Rank 4 is GameStop, GME. That bullish volatility breakout potential, defined by the huge short interest and options skew, plus the coiling pattern. But we have to stress this is high risk, probably the lowest probability of actually playing out smoothly. And rank 5 is Apple. AAPL, potential bullish range breakout. The options data is supportive and it's holding key levels, but it's fighting those negative tariff headlines and the technical picture is mixed.
So it sounds like the clearest, highest conviction plays right now are those catalyst-driven squeezes like KLG and PLG. They have fresh news and a market structure that supports the move.
That's how we see it for the immediate term, yes. NVIDIA is strong, but maybe needs a pause. GME has huge potential reward, but comes with equally huge risk. Really only for speculative traders comfortable with that volatility.
Okay, this has been a fantastic deep dive into navigating these choppy waters. I think the core takeaway is that even when signals seem to fight each other, you can find clarity. It's about prioritizing the newest, most impactful information and really understanding the forces underneath.
Absolutely. And maybe a final thought to leave you with. Knowledge is great, but it's most valuable when you actually understand it and apply it. So the next time you face conflicting signals in your own investing decisions, ask yourself, which signal will you choose to prioritize and why?
Great point. Well, thank you for joining us on the deep dive. Make sure you subscribe so you get these insights quickly and frequently. You don't want to miss the next one. We'll see you then.